Just 5 years ago, PPFS and Quant mutual funds were very small. In March 2019, PPFS managed assets worth around 1900 crores. Quant was even smaller, with just 133 crore assets under management. At that time, giants like SDFC Mutual Fund and ICICI Mutual Fund were managing assets in excess of 3 lakh crore each. And now, both fund houses have come a long way since then. PPFS now manages assets worth around 68,000 crores. Quant, on the other hand, has about 66,000 crore assets under management. Now, it's no secret why these fund houses have seen such outstanding growth. Both have consistently delivered high returns, which have made investors flock to them. And while they have seen similar success, their investment style is exactly the opposite. PPFS comes from the Warren Buffett school of thought, and so the management team follows the value investing approach. It buys and holds stock for the long term. On the other hand, Quant doesn't follow any specific investment style. It buys and sells stocks based on an in-house investment model. And it doesn't shy away from buying and selling stocks within a few weeks or even months. So, which of these two fund houses is best to manage your money for the long term? Should you opt for the traditionalist PPFS or rely on the fund house whose investment approach is unique but could be difficult to understand? Hello and welcome to ET Money's YouTube channel. In today's video, we are going to look at two things. First, we will deconstruct the portfolios of these fund houses to understand their investment style. And second, we will compare the performance of these fund houses in different market phases. Now, based on the data and analysis, we are sure you will be able to pick the fund house that's best suited for your portfolio. So I would recommend you watch this video until the end to get the most out of it. For PPFS, investing in stocks is like buying a business. The investment team looks at fundamentals, valuations, and management quality before it invests. Typically, PPFS would invest in companies with a competitive advantage, pricing power, low debt, high return on capital and equity, and are also available at a good price. Now, according to the CIO Rajiv Thakkar, PPFS prefers to hold 25 stocks in their funds, which makes it neither too concentrated or not too diversified. The AMC also doesn't believe in using algorithms, momentum, technical analysis, or timing the markets. Quant Mutual Fund, on the other hand, uses frameworks and models. The framework called VLRT helps the fund house predict which stock to pick and when to buy and sell them. The model suggests stocks based on valuation, liquidity, risk appetite, and time. It looks at a variety of data to predict which stock is likely to do well. Now, according to media reports, the fund house has spent around 180 crore on acquiring data to strengthen its model. The stock picking, however, is not entirely model driven. The model only identifies stocks using various quantitative factors. The 18-member analyst team then does qualitative analysis and presents the stocks to the chief investment officer. The fund managers take the final call. Now, as you can see, the investment philosophies of the fund houses are poles apart. On the one hand, PPFS believes in age-old value investing principles, doesn't like using algorithms, and prefers not to time the market. On the other hand, Quant challenges conventional investing principles. It uses models to invest in stocks and believes in timing the entry and exit. Alright, now let's take a look at how these fund houses use their investment philosophy to run their schemes. We will first look at the number of stocks the fund houses hold in their schemes. This will tell us if the fund houses have a high conviction in their stocks or prefer to play it safe. A high number of stock means the fund manager likes to take a diversified approach. This leaves room for errors. Even if a few bets go wrong, the portfolio will not be severely impacted. Now, while a lower number of stock means a concentrated portfolio, it also means that the fund manager has high conviction. In the previous section, we discussed that PPFS prefers to hold around 25 stocks in its portfolio, but the recent data shows that things have changed. As of March 2024, the AMC had 55 stocks in its FlexiCap fund and 39 stocks in its ELSS fund. Now, before 2023, the fund house held around 25 stocks in the FlexiCap and ELSS funds. However, the number of stocks have increased in the past 2 years. A possible reason for this increase in the number of stocks could be the rising AUM. A higher AUM reduces the fund's ability to invest a large sum of money in a single stock. and as a result, the fund needs to scout for more opportunities to deploy its money. That could be one reason for the increase in the number of stocks. But 55 stocks are still not a lot for a fund with over 60,000 crore assets under management. Alright, let's now look at the number of stocks in the equity schemes run by Quant Mutual Fund. The fund house has 21 equity funds, most of which have around 25 to 40 stocks. The only exception is the small cap fund, where the number of stocks is around 90. So both fund houses maintain a balanced approach. Their funds are neither too concentrated nor too diversified. They have a high conviction in their stock picks. Next, let's look at the PE ratios of their portfolios. We examine the PE ratios because it gives a quick overview of the valuation of stocks in the portfolio. However, we would like to add that investors should avoid looking at the PE ratio when choosing a fund. Now, over the past few years, the PE ratio of the PPFS funds have varied between 20 to 28. So most stocks they hold trade at a reasonable valuation. On the other hand, the range is quite wide for different schemes from Quant Mutual Fund. It varied from 18 to 58. So it appears that PPFS is very particular about what it is paying for a stock. Quant, on the other hand, is fine with buying stocks at slightly higher valuations if its model suggests so. Now, conventional wisdom says that stocks trading at a premium fall faster when markets correct, so it can impact returns. Next, let's look at how often schemes from the two fund houses buy and sell stocks. To know how often a fund buys and sells stocks, we look at the portfolio turnover ratio. A ratio of more than 100 means that the entire portfolio was churned in the past year. For PPFS, the ratio has been low. The ELSS fund's turnover ratio is in the single digits, while the Flexi Caps has been below 30. Now, this suggests that the fund managers don't like to churn the portfolios frequently. Instead, they buy a stock and hold on to it for the long term. On the other hand, schemes from Quant show a high portfolio turnover ratio. In most cases, it was above 100, and in some funds, it was as high as 800. This high number suggests that the VLRT model of the AMC generates frequent entry and exit signals. Now, to see if that was true, we looked at the stocks the fund houses bought, sold, and reinvested in the same year. For example, let's look at the data for the Quant FlexiCap fund. You can see a table on your screen that shows some popular stocks that the fund bought, sold, and reinvested again between April 2023 and March 2024. Now, one good example is Tata Communications. The fund bought over 30,000 shares of the company in May 2023. Then, it bought more shares in the following 2 months. In August 2023, it completely exited the stock. It reinvested in Tata Communications in October 2023 and sold it completely 3 months later. This is why the fund has a high turnover ratio. Now, some of you who believe in buy and hold might find this investment strategy crazy, but the fund house follows a non-conventional investment strategy which has helped it generate returns over the past few years. In case of the PPFS, if we look at the FlexiCap fund, you will find many stocks that the scheme has held for past 5 years. Such stocks include Alphabet, Amazon, Axis Bank, Bajaj Holdings, Balkrishna Industries, Dr. Reddy's Laboratories, Facebook, and HDFC Bank. Alright, we have seen the differences and similarities in the investment styles of these AMCs. Next, let's analyze the performance of these AMCs in different market phases. We will compare the performance of the two fund houses by comparing their ELSS and FlexiCap schemes. For this, we first look at the monthly returns of the funds. From these monthly returns, we chose periods when the differences in returns from these funds was more than 3 percentage points. Now, for the FlexiCap schemes, there were 27 months where the difference in the performance of the two funds were more than 3 percentage points. Out of these 27 periods, Parag Parekh FlexiCap fund performed better in 14 periods, while Quant FlexiCap fund performed better in 13 periods. Surprisingly, when Parag Parekh FlexiCap fund did better, the Nifty 50 returns were either negative or flat. In other words, Parag Parekh FlexiCap fund did better when the markets were either correcting or consolidating. On the other hand, Quant FlexiCap fund did better when markets were positive or rallying. From this data, Quant's investment style is likely to perform better when the markets show positive momentum. However, if the market goes sideways or if it corrects, then the value investing style of PPFS may perform better. Now, we did the same exercise for ELSS from the two fund houses. The results were the same. Here, there were 22 periods when the difference in returns of these two schemes were more than 3%. Out of these 22 periods, PPFS did better in 8, during which time markets were either corrected or were consolidating. Quant ELSS did better in 14, during which markets had positive momentum. From this quick analysis, we see that Quant's high returns come from capturing the market upside. Even when there is a correction, the high returns during the positive market momentum don't adversely impact the fund. Meanwhile, the PPFS delivers high returns consistently by falling less than the market. Now, based on the investment styles and the performance that we just saw, you can decide which fund house is best suited for you. However, as we can see, the investment styles of both fund houses are different and perform better in different market conditions. So, rather than sticking to any particular investment style, a better approach could be to have both in your portfolio. For example, you can invest in the FlexiCap for PPF and ELSS from Quant or vice versa. And with this, we have come to end of this video. I hope you found the content helpful. And if you did, do share it with your friends and family. I'll be back with another video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.